Let's talk about the impact of your asset allocation versus the impact of fees on your portfolio performance. And I bring this up because I know and I see a lot of investors really obsess and burn a lot of mental energy over their asset allocation. For example, should they be 60% US stocks, 40% international stocks, or 70% US stocks, 30% international stocks? Because as we all know, over the last 20 years, US stocks have absolutely crushed international stocks. Should they had 5% of bonds, 10% bonds, or maybe zero bonds because they just don't bring enough risk for reward? They don't bring enough reward for their risk to the portfolio. Should they add gold or some other natural resource in there, right? There's a million and one ways you can slice and dice a portfolio. And a lot of investors spend a lot of time obsessing about this. Meanwhile, they're overlooking the impact of fees on their portfolio. So, this blog post right here, originally published back in May of 2016 by Meb Faber, titled "Which Institution Has the Best Asset Allocation Model?" really sheds a lot of light into the into the impact of asset allocation versus the impact of fees on a portfolio here. And I think it's very insightful. So, I followed this blog for a very long time, and I found this blog post back in 2016, and I've made a mental note of it and really kind of kept it in my back pocket at all times. And well, now I'm sharing it with you guys here on YouTube and my take on it. So let's just kind of run through it because what they did is really interesting. What Meb did here, I should say, is really interesting. But he took a look at 40 institutional asset allocation models, right? And we can see them all here from Atlantic Trust to Citibank, Fidelity. We all know Fidelity, JP Morgan, Morgan Stanley, right? In all of their institutional asset allocation models. And now behind them, no doubt, is a massive 40-page white paper backed up by probably millions of dollars in research explaining and justifying why they have this chosen asset allocation model, right? Atlantic Trust, for example, no doubt when they, adopted this institutional asset allocation, they no doubt had a bunch of research and a white paper behind why they were 38% US equities and only 9% developed international markets equities and 2% emerging markets, right? So, multiply that out by every one of these 40 had that paper. Okay, they all put a lot of research into picking the best asset allocation that they could. Well, he looks at how they performed going forward here, or over the last 40 years, over a big period of time. Let's just scroll down. And in this chart, he graphed the highest performing asset allocation model versus the lowest. And we can see the data here. The most aggressive had a 9.72% compound annual growth rate, or 9.72% return, we could say, while the least aggressive had a 9.19%, and the average was 9.6. So the difference between the most aggressive and the least aggressive of these 40 plus firms was only a little over 0.5%, 53 basis points. Like, that is shockingly close. I remember when I first found this research, I did not expect them all to be so close, right? So for all of the countless hours and millions of dollars of research that went into, each company finding their perfect asset allocation model or the one that they thought was going to outperform, they were all really quite close over time. And this chart indexed to 100 here, right? And this would imply that, or be hypothetical of a situation where you invested $100 into these asset allocations. The best performing one would be worth maybe 3,300. I don't have the exact data. I've only got the data that you can see on this chart, so I'm kind of drawing a fictitious line, versus the lowest would be worth maybe 3,100. Very, very close in performance. Meanwhile, there were some pretty big differences between them. I think, what is it here? All right, I had a glitch in my screen recording software there, so I'm going to try to pick up where I left off, and that is the one with the highest allocation to stocks was Deutsche Bank at 74%, and the one with the least amount had 44% in stocks. So that is a pretty wide difference, pretty wide range of allocation to equities. These 40 institutions, no doubt, had 40 pretty different asset allocations, but over a big time period, what is this, 42 years, they all turned out to perform very, very similar. What Meb did next here is very, very interesting, and this is where the impact of fees was taken into account. He modeled these asset allocations out, or the highest asset allocation out, by applying a 1% management fee to it. And that's what we see in this chart right here. The highest performing asset allocation in the blue line with a 1% management fee layered on top of it, suddenly over this time period becomes the distinguishable worst performing asset allocation. And that is just a 1% fee, right? And oftentimes a 1% fee in the financial services world, if you're not proactively trying to minimize fees, is quite normal. It's not uncommon to find a lot of like target date funds with about a 1% fee. Usually I find they hover just below that 1% mark. They're like 0.96%, right? And layered on top of that, a management fee by some type of advisory service. So then you're paying 2% for the total portfolio. Well, a 1% fee absolutely takes a big haircut out of the portfolio, and no one really considers that. Let's layer on here a 2.25% fee, which is what I think he did next. And then it becomes glaring, right? Look at that. 2.25 being this turquoise blue line here at the bottom. Just a glaring, glaring haircut. And if we look at this in terms of total return here, indexed to 100, mind you, you'd be at, what, 3,300 about for the highest or average performing asset allocation. Layer in that 2.25% fee and you're down at like 1,700. I mean, that over time, over this 42-year period, nearly cuts your total return in half. It is huge, 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 huge. So the point I want to make here is that don't spend so much time obsessing about your asset allocation. A simple asset allocation, often just a 3-fund portfolio, will outperform most more complex and rigorously vetted and highly researched asset allocations. A 3-fund portfolio is, in many cases, generally the best choice you can go with at such simplicity and low cost. You can implement a 3-fund portfolio for less than 10 basis points. But the big thing, though, is just don't spend so much time obsessing about it while overlooking fees, too. Figure out how you can get a low-cost fee for what would be, your static buy and hold asset allocation. Figure out how you can get that at the lowest cost, because ultimately your asset allocation really doesn't matter that much, as you can see here. On that note, guys, if you found this video helpful and insightful, you know the drill. Smash that like button to help me out in the YouTube algorithm. I am calling it a wrap and signing off.